Hello, young traders. Doing your video once again from DRFX, Swing Trading Mentoring. Going to be taking a look at a recent trade that was made on the New Zealand Canadian dollar, where my subscribers and I captured a trading gain of 50 pips as we traded the formation of the consolidation setup that was gradually taking shape on the daily chart, which was also being supported by a strong bull crown setup that had already been formed on the 4-hour chart. Now here you can see the summary of this trade, which gave us 50 pips. And on my live account, this actually represented a rate of return of 1.86%. Now, this was the latest in a series of trades made over the last several weeks, which provided a rate of return of 16.76% on my live account within just 5 weeks and from just 6 trades, essentially showing you that a rate of return of 14% a month is definitely possible, and that once you can achieve this on a consistent basis, then it means that these are the types of rate of returns that are possible for us within just 6 months. Now, the setup that was traded on this currency pair was an example of this type of setup that we trade as part of my trading methodology. Essentially, what we do is, instead of waiting until the consolidation has been finally completed and then trading between the boundaries of resistance and support, what we do is to spot and trade the early set of bullish and bearish waves that tell us that the market is going to be forming consolidation. So once we can spot these waves early out and the signals provided by the daily chart and the 4-hour chart are strong enough, then we can trade them and capture early trading gains and continue to trade this way until the consolidation has been finally completed. Now, in terms of market analysis and trading, I actually use 2 trading platforms. The FXCM is the one that I use to identify market direction and entry signals based on Japanese candlestick signals. However, when it comes to my live trading, I actually prefer to use FXPRO for 2 main reasons. The first is that you can actually see the risk and reward values of the trade that you're about to make in percentage terms, which I think is very important. And the second reason is that you can actually receive email alerts informing you when the trade has been completed, so that you do not have to monitor the trade, which, as you know, can lead to a lot of bad habits such as closing our trades much too early. Now, this was a setup on the New Zealand Canadian dollar daily chart, where, based on the nature of the bullish and bearish waves that have been formed, it was telling us that the market had a high probability of actually forming a consolidation setup on this time frame. So as you can see, the most recent signal was given here in the form of this morning star. You can also interpret this as being a bullish engulfing candlestick formation as well. And it was telling us that the market was going to be rallying as part of the continued formation of this consolidation. And as part of this rally, it was also going to be providing us with a trading opportunity to capture a trading gain as part of this movement. Now, taking a look at the 4-hour chart, what was discovered, what was noticed, was that the market had actually formed this bull crown setup, which, as you know, is one of the strong indications that the market is about to start a trend change. So here you can see that the market had formed this downtrend and this downtrend line and gradually formed this transition setup that is called a bull crown setup, otherwise known as a head and shoulders pattern. And this was telling us that the market was going to be starting an uptrend that would provide us with this trading opportunity. So the market provided us with this left tip, which was the last setup as part of this previous downtrend. It then provided us with this center tip as the market U-turned and broke this downtrend line, and then provided us with this right tip, which represented the first formation as part of the new trend direction. In this case, the bull, in this case, an uptrend that was going to provide us with gains in favor of the New Zealand dollar. Now, bull crowns and bear crowns, otherwise known as head and shoulders patterns, very common across the currency market and across all time frames. And basically what it means is that, our basic structure of it is that the market will form one last setup as part of the previous trend, which would be what we would call the left tip or the left shoulder. It will then move one last time in the direction of the previous trend before U-turning and breaking trend lines that would have been formed along the way. And in so doing, it would form the center tip or the head of the pattern. And then as it transitions towards the new trend direction, it will form a third setup, which will be the first setup as part of the new trend direction, which we will call the right tip or the right shoulder of the formation. This right shoulder or the right hip would also be the area where we would enter the market to take advantage of this new trend direction. So as you can see here, what was done was to enter the market at the close of this bull candle as part of the formation of this right hip. The stop loss was placed just below this uptrend line at 0.8955. Target was set at 0.9070, which was an area just below this resistance point. So this was a setup, and the trade signal was sent to my subscribers. And as you can see here, the market rallied as expected, hitting our trading target and providing us with a trading gain of 50 pips. You can also see this trade result here on my live account. Entry took place at the close of this bull candle, and the market rallied steadily and eventually hit our trading target for 50 pips. Now you might be wondering, why is it that I decided to exit the market at this area here instead of at resistance? The reason for this is that when it comes to bull crowns and bear crown setups, it's sort of 50-50 in terms of when the market will actually head towards the other side of the boundary, in this case resistance, and whether or not it will actually pull back and start to reverse without actually hitting this point. So to avoid the possibility of the market reversing before my trading target has been hit, I usually tend to opt to exit the market just before these targets are hit, just in case the market starts to reverse. However, there are other signals that are much stronger and that have a much higher chance of actually carrying us towards the other side of the boundary in terms of a trading target. So in those situations, we would actually, with setups such as double bottoms and double tops, or even strong ABC signals, those are the signals that would tend to have a lot more momentum and would have a much higher chance of carrying us all the way towards the resistance or support points. However, when it comes to bull crowns and bear crowns, these do not generally have as much momentum, and so it is generally the better option in my preference to actually exit the market just ahead of these areas, just in case the market decides to pull back. So this was a good trade which allowed us to capture a trading gain of 50 pips within 24 hours. And on my live account, as I mentioned before, this represented a rate of return of 1.86%, which I think is a very good rate of return for one trade to be captured within a 24-hour holding period. Now, the main elements and factors that were related to this trade, which are very important in terms of being able to successfully take advantage of similar setups. The first one is that we have to ensure that we're able to draw the setup correctly and accurately. There are many schools of thoughts in terms of how we draw trend lines and consolidation patterns at the boundaries of resistance and support. However, the way that I have discovered is the way that I think is the best and the most accurate way, and this will allow us to better able to identify whether or not the market is still moving within consolidation or whether it has already started a breakout. The second important factor is that we have to make the distinction between the signals that are risky and those that are strong and that can be traded. Movements within consolidation can be characterized by strong movements as well as weak movements and weak signals. Weak signals can provide successful movements between resistance and support, but they tend to have a low chance. They tend to have a high risk factor. So it is very important to be able to make the distinction between those signals that are strong enough and those that are too weak and that are too risky. Also need to make the distinction between strong stop loss and weak stop loss areas. Very important, because this will make the difference in terms of whether or not we're going to be able to stay in the trade and withstand temporary pullbacks until our trading target has been hit. As I said before, it is very important to also make the distinction between situations in which we can aim to exit the trade at the resistance or support point, or whether it is better to exit the market just ahead of these areas. So it is very important to make the distinction, and that distinction can be made in terms of the type of signal that has started the trend that we're trading. So certain signals have enough momentum to take us all the way towards these areas, but some of other signals do not necessarily provide that momentum all the time. So we have to make the distinction between those type of signals which will help us to make the distinction in terms of where we should exit our trades. And of course, finally, it is very important that we are aiming to capture a strong enough trading target and pip target, and that we should also ensure that we're aiming to capture this trading gain within a particular holding period, because one of the risks of trading the currency market is that we can hold our trades too long, and if we hold our trades for too long, then we run the risk of the market reversing and taking away our trading gains. So it is very important to establish a holding period and to be sure that in most cases a particular trading target and pip target is like to be hit within a particular holding period. So as you will see on my website, I've established a holding period of 24 hours, which is the holding period that I expect, and that in most cases the market will capture and provide us with a trading gain of between 50 pips and 70 pips in most cases before the market reverses. So it is very important to establish a holding period that will allow you to safely capture your trading gain before the market reverses. So that's it in terms of this trading gain that was captured on the New Zealand Canadian dollar. Basically showing you how we take advantage of the formation of a consolidation setup as well as bull crowns. And if you have any questions, you can let me know. You can email me at shepherddwayne@gmail.com. You can also find me on Facebook and Baby Pips using the same username DRFX Trading, as well as on Twitter at Worldwide876, as well as on my website, swingtradingmentoring.com. So until next time, traders, happy trading.